Equities saw their biggest decline since October as the coronavirus stole the headlines and brought a little bit of fear into the market, at least for a moment, as we saw declines across the board in equities. However, there was a modest relief rally towards the end of the session with the idea that maybe some of this is contained or it isn't quite as bad, or it could have been some of those looking to buy the lows and maybe this will pass in the coming weeks, that fear of missing out buyer that's been keeping this market elevated for some time. One other point of note, this is the first week over week decline we've seen. We didn't get back above 3,300 in the E-minis, but it's the first week over week decline of the year and the second over the last 10 weeks. So obviously the trend is still very much a bullish move in equities higher. Will continue despite the fact that we saw a hiccup today and declines that were slowly recovered. In the bigger picture, if this becomes a bigger mess or a bigger disaster, a bigger health scare, obviously we know now there is some downside risk to equities that won't be met with buyers with both hands. They will wait for calmer waters, but at least heading into the weekend, things seem to be a bit calmer than they were on the open. And the VIX index did see a bit of a move higher, but albeit given the circumstances, the VIX at 15 doesn't feel like the VIX at 50, where it probably would have been several years ago. So volatility remains stubbornly low, although we did see a move higher off the lows that we've been trading on, but certainly nothing that would suggest that this is going to be a long-term fear to the market. Lastly, let's look at what we have ahead. Yeah, we're going to continue to talk about this coronavirus over the weekend. Any fallout, any new stories, any news, developments, whatever, that will continue to steal headlines. Likewise, we have an FOMC meeting and we have this darn impeachment trial going on in Washington. Now, the latter two really haven't had an effect on the equity markets. Obviously, the Fed remains on hold and they continue to watch and wait for reasons why they could hike rates in the future, but no one really believes that they will, given the global economy, given what's happened here, given what's going on in the short end of the market. And I think that the stocks will continue to ride that train. The impeachment trial, although, hasn't really had much of an effect on equities either, and that's surprising given the fact that the most powerful office in the world is up for grabs here, or at least at risk, and the markets are kind of shrugging that off. So at this point, I think equities will continue. The only thing that can really stop the equity march higher would be any sort of any evolved cases in this coronavirus or something worse. Likewise, if we see the economy, the global economy start to falter, while it does mean that rates will remain low, you might start to see some risk-off traders come in. The fear of missing out trade buyer has been there. He wasn't there early in the session today, but likewise, he came back late in the session. Those buyers may be getting a little bit thin as we are still sitting very top-heavy in the equity markets. And the fact that we settled below 3,300 isn't all that big a deal. If we had settled 50 handles lower, maybe it would have created a technical hiccup in the recent bullish trend, but we didn't get that. So at this point, equities remain very bullish. We'll have to wait and see where the dust settles next week after FOMC, but I don't see any reason why the Fed would stop this bull train in equities, and if they wanted to, I don't think they could.